Welcome to Kitchen Table Finance.
Hey Dave, how you doing today?
I'm doing great, Nick. How are you?
Doing well for a Wednesday podcast.
Kind of weird,
talking
right?
about the markets. Lots of my favorite things going on right here, Dave.
Yeah. It's a beautiful summer day, so let's sit inside and talk about money.
There you go. Let's have at it. So This is our quarter two review and looking ahead outlook for next quarter that we do every quarter. So with that, for those of you that are new to the podcast, we always like to start with the kind of looking at both sides of the equation with our glass half full, glass half empty. And just kind of talking through, what looks good, what potentially could harm things, because the reality is we never really know, right?
Right. Well, and to set the stage a little bit, I mean, April, May, June of 2025, wild ride, right?
Yeah.
I mean,
to say the least.
Yeah.
I mean, if you just look at like the stuff that happened, you're probably never guessing what the market returns are.
Yeah. We ended up in a very good spot here at the end of the quarter, but boy, things looked bleak in early April, coming off of a lot of upheaval around tariffs and trade policy. And, before that, we already had concerns about valuations and AI and where things were going to go from there. Our average client is probably in a 60, somewhere around 60% stocks, 40% bonds. Oh boy, I had these numbers at my fingertips a second ago. The average, return on a 60-40 portfolio for the quarter. If we had talked to people, told them, relax, you're going to end up, positive 6.5% for the quarter.
Yeah. Oh yeah.
On a 60-40 portfolio, which is about what it did. 6.58 for April to June. They would have thought we were nuts.
Yeah, it's funny because we had a lot of those conversations around like, just don't worry, this isn't the time to like move things around. And then, I love it when the market rewards us quickly like that.
Well, I mean, that's a double-edged sword too, right? Because then,
sure.
you don't want a client coming in next to going, boy, you were right, and then, just in time for things to turn the other way, because that's kind of the point, right? We can't measure in 3-month chunks. 3 years really should be the minimum evaluation process. I think they'd take away our credentials if we didn't stop and talk about the market every quarter at least, right?
Oh, for sure. Sure. So with that, Dave, let's delve into a little bit about what kind of happened and what we see going forward. We talked about a little bit, but U.S. stocks obviously rebounded well in the second quarter, led by larger company U.S. stocks. For sure.
Large cap growth, close to 18% for the quarter.
Been the sector that has really kind of taken it on the chin to begin the year, which is why you see their year-to-date numbers at 6.1.
Yeah.
So, but all things considered, a great quarter for the market. Last 12 months still look really strong. The all cap looking at 15.3% the last 12 months. Very strong positive market returns. And we've also seen short to intermediate term bonds perform well in Q2 as well.
Yeah. Interest rate policy is still anybody's guess right now. We've got a pretty good argument going on between the administration and the Federal Reserve about where interest rates should be, but the bond market's hanging in there.
Yeah, that's all with the caveat that the U.S. government bonds were downgraded during the quarter.
Right.
So
Right. Yeah.
Go figure, right?
Yeah, that happened, and everybody just kind of shrugged, which is what's happened historically when U.S. debt has been downgraded. Maybe the biggest surprise right now is how the labor market and macroeconomic data in general still suggest we're doing pretty well.
Yeah, absolutely. I mean, if you look at the things that we were concerned about potentially getting worse, the reality is that they continue to perform very well. Labor markets, even inflation hasn't really seen a big shoot up as a result of tariffs, which was always kind of the concern and the cautionary role that the Fed took. Okay, we haven't necessarily seen the full effects of tariffs.
Right.
or
Right.
inflation on tariffs. I'm kind of bouncing around a little bit, but
Right. It's still quite likely we're going to see more inflation feed into the system here as the tariff picture becomes more clear. But it's not showing up yet, and that's a good thing. So far, we'll take it.
yeah, it's just one of those things that, and we've talked about it before and done several episodes on it. It's just because this economy is so different than the previous times when we had major tariffs like this, we're just not really sure what the market reaction is going to be to the tariffs, how that's going to impact
Yeah.
inflation, and also because there seems to be so much uncertainty around what those tariffs are actually going to be. Are they going to stick around? What are these trade deals going to look like? That we just haven't really been able to get a good grasp of what the end result is going to be or what this administration really wants to get out of these
Yeah.
trade deals. And so as a result, you see a lot of volatility that we'll talk about here in a little bit as those kind of discussions are ongoing and as the
Yeah.
information gets released. But the market basically now has just kind of shrugged it off as this probably isn't, it's the market is acting like this isn't going to be a major thing. It's not going to slow down growth, and whether or not that's true, I guess we'll see.
Yeah, it's interesting because there's a definite disconnect between the rhetoric that's out there around trade policy and tariffs and what the market is actually expecting to happen.
Yeah, for sure.
Yeah.
To be determined. Stay tuned.
Yeah.
I think we're at the inflation point of the discussion.
There we are. Yeah. Yeah.
Reoccurring themes here going on every quarter
Yeah.
that just don't seem to go away. But inflation did decline to 2.4 in the reading from May relative to 2.9 that we
Right.
saw in December. So that is still moving in the right direction.
Right.
Like we said, that is despite the tariffs, but might not include the full impact of them yet to be
Yeah.
determined.
And I feel like we need to add a little sub bullet here that, last week CPI for June came out and there definitely was an uptick that is being attributed to the tariffs, but it wasn't, I think where'd we come in? 2.7?
Sounds right.
Yeah. Stay tuned. We'll see how that unfolds here over the next couple of months. Not a drastic jump, but definitely starting to see that a little bit there.
Google tells me 2.67, so we're going to give it to you.
2.67. Okay, so I rounded up.
Solid job. So on the glass half full side, those are really the 4 points of kind of what we've seen in the markets, right? Short to intermediate term bonds, U.S. stocks doing well, macroeconomic data still strong, inflation actually going down, ticking up a little bit, but still down from December and in that 2% range that the Fed wants. And then on the glass half empty side, we alluded to some of this already, Dave, but there is continued uncertainty around tariffs, ongoing trade wars between the U.S. and international trade partners. Seems like we get through these things and then all of a sudden they rear their head again. And so there's not a lot of progress being made necessarily.
Yeah.
We've had some pauses along the way, and so what comes next, I guess, is anyone's guess at this point.
Yeah. As we started to record today, I saw that we've worked out a trade deal with Japan. So
nice.
There's one country down. The next bullet point we kind of touched on a minute ago or two when we were talking about bonds on the positive side of the ledger. But, we do have to remind ourselves and everyone out there that the U.S. federal government debt was downgraded in May. Oh my gosh. Surprise, surprise, fiscal irresponsibility. It was basically on the backs of very light spending cuts in the recent fiscal plan, accompanied by more tax cuts.
Yeah. So interestingly, I mean, the U.S. has been downgraded before. It was previously downgraded by S&P, and now Fitch downgraded them. But like you said, bond performance was still pretty good. Interesting statistic for you, Dave. There are now 2 U.S. corporations that are more highly rated than U.S. government debt.
Yes.
Do you know what they are? Did you cheat? Do you already know the answer to this?
I did not, but I'm going to take a stab at it.
Yeah.
Microsoft?
Yeah.
And does Apple issue bonds at this point?
Johnson & Johnson.
Johnson & Johnson.
Yeah. There you go.
Interesting. That one I would not have guessed. Good.
Interestingly enough, what we didn't see is everybody selling their U.S. bonds and buying Microsoft and Johnson and Johnson. So
Right.
take it for what it's worth.
Which I remember, and 2011 when Standard and Poor's downgraded the federal debt. What happened? Yields on federal debt went down.
Yeah.
Because the best anybody could come up with at the time was, boy, if federal debt's bad, everything else must be worse. And money flowed into the U.S. bond market. So
there you have it.
The bond vigilantes would say at some point we pay the piper.
Yeah. So, it is an interesting thing to watch. Obviously, the downgrade, and, you could make a pretty strong argument that these rating institutions have had a long track record of not
being silly.
Yes, being silly. I like that. But that being said, we haven't seen a big impact in the price of treasuries. Right. At least that hasn't impacted it. But it is an important number because a lot of other rates are based on those, right? And so when you start talking about mortgage rates and where they're at, a lot of that is based on the 10-year treasury. And
the spiraling problem as debt comes due and having to refinance it now at higher rates, which increases your cost,
right. And puts more pressure on the Fed to potentially lower interest rates. Like all of that plays into it.
Mm-hmm.
This one has not left our glass half empty for a long, long time, and that is continued geopolitical concerns in the Middle East and between Russia and Ukraine. If anything, things continue to either drag on or potentially get worse to some degree, especially as it relates to the Middle East. And so it's one of those things that definitely is going to impact global markets. And the worse it gets, the bigger the potential impact, right?
True. It's always hard to quantify a regional conflict in terms of what it means for a global market. My sense of the matter, and this is back of the napkin stuff here. I'm not pulling out exact statistics or anything, but the idea that for the most part, when we have disruptions, regional disruptions like that, it does impact the markets in the short run because people are trying to quantify and figure out what the economic impact is. But generally, the economic impact over the long run hasn't been that great and we tend to see the markets rebound after an event. We'll see how it plays out. But yeah, it's been pinned on this list for, I'd have to go back and check, but at least, in terms of the Middle East, at least since October 23.
Yeah, for sure. And the last bullet point here on the glass half empty side, which we've talked about a little bit already, is that we just aren't sure what the full effect of tariffs on inflation might be. A lot of what we saw last quarter was a lot of businesses pushing stuff through before the tariffs went into place. And so there was this like extra supply, if you will. And then as that slowly dwindled down, then people had to actually make active decisions about tariffs. And, is the company going to pay it? Are the consumers going to pay it? And I think you even had firsthand experience with this, didn't you, Dave?
I did. Yeah. I just last week received a product that I bought that was made in Italy, and it was imported by a small company, very small company, like 3 employees. And they had warned me back in April that they were going to have to pass the tariff on, but we were going to wait and see what it was going to be when it shipped. And they actually gave me a choice. When it was ready to be shipped, they said, okay, the tariff's going to be 10% if we ship right now. But, the administration's supposed to be negotiating with Italy and the EU over the next couple of weeks. So you can either have us ship it now and pay the 10%, or we can hold off, let it sit in Italy for another few weeks and see what happens. I chose to go ahead and have it shipped. A couple interesting things. One is it's right on my invoice. This was the tariff amount, and there was a lot of people who didn't believe that was the way it was going to work. But I paid that tariff as the consumer. With some companies, they could have decided to split that with me, or
Sure.
some combination. But this company made it quite clear early on, like their profit margins are just too skinny for that, and I get it. And it's interesting too, because when we look at how stocks behaved during that period, during this period with the tariffs, it's been the small company stocks that have really been under the most pressure with the tariff
Yeah,
volatility, because
for
small companies
sure.
just can't absorb that. And a lot of customers are just going to say, nope, cancel my order. It's interesting, but that's
It's
my
having
personal,
long-ranging effects. I
yeah.
heard that I think it was the Wall Street Journal that did a piece on Amazon actually raising their prices on a lot of
Hmm.
consumer goods, even
Yeah.
after they said they weren't necessarily going to. Where
Yeah.
Walmart so far has been able
Been
to
able to
not,
absorb it. Yeah. Well,
but
and you get some gamesmanship there too, no
oh,
doubt,
for sure.
where,
Yeah,
if Walmart may look at it and say, okay, we can steal market share from Amazon if we leave our
right.
prices low. And
Yeah.
yeah, we're not going to be as profitable, but we'll make it up on volume, if you will. Yeah. So there's lots of maneuvering going on. Who knows how it's going to play out at this point?
Yeah, it's an interesting, example that you gave too about like, okay, do I do it now and pay the 10% or do I roll the
Yeah.
dice? And it reminds me of like back in 2020 during COVID when all of a sudden wood prices were going crazy and Home Depot
Yeah.
had digital pricing because they had to change it so often on all their
Yeah.
wood.
Yeah.
It's just like the uncertainty of it. It's
Right.
something that we just haven't seen like that before. So interesting
Yeah.
for sure. As we said, the point of that is because we're just starting to get and see some of the stuff on tariffs, a company like Walmart might absorb it for a while, but I guarantee you that they're not going to absorb it forever. And they're definitely going to have to find a way to be profitable. And
Right.
that's probably going to mean
Right.
increasing prices on some things for sure.
Right. Yeah. Did you want to look at some of the significant numbers from the
Yeah, let's
last
go into
quarter? Yeah.
let's put this into context a little bit with some of the numbers by review. Our first
Yeah.
number is 90 plus 23,
Yeah.
which represents the original 90-day extension by President Trump from April, when he lowered the Liberation Day reciprocal tariffs to 10%. Recently extending that another 23 days, and so the deadline is now August 1st. So 90 plus 23
Yeah. And a lot of
and
work to
counting.
do in the next
Yeah,
week and a few days.
exactly. Yeah, this shocked
9
me.
all-time highs for the S&P 500 index during the first half of 2025.
Yeah.
I
And then the second part of this, I think, was even
Yes.
more surprising, the single day increase of 9.5% on April 9th.
Yeah. Imagine if you had put your money in on the morning of April 9th, you could have
Yeah.
cashed out in the afternoon and been like, this was a pretty good year.
Yeah, exactly.
Thanks, I'm good. Yeah.
If it was
Yeah.
only that simple.
Sounds easy, doesn't it?
Yeah, for
Uh,
sure. Next number is negative 5.6, and that represents the median S&P 500 drawdown on reaction to geopolitical
yeah.
shocks throughout history. So it's the average drawdown when we have geopolitical shocks. And then the final one is 7.2%, and that represents the year to date return of a 60/40 portfolio. That's using MSCI All Cap World Index, and it's 60% and 40% the Global Ag
Yeah.
Bloomberg Index. In other words, despite unnerving headlines, globally balanced portfolios are doing quite well, actually outperforming the
Right.
S&P 500 by 1% this year. So
Right. Yeah,
the goal,
is it cool to be in international stocks again? Has been so far for the last
right?
6 months.
Well, not to mention, it didn't seem that long ago that the 60/40 portfolio was dead. So I
Oh,
guess the resurrection is complete, right?
well, just wait till the next negative quarter and you'll see
Yeah.
those articles again.
Oh, of course.
Yeah.
But all in all, it's quite surprising. I think a lot of people are looking at their statements and going, wow, we did a lot better than I thought I would have. And that's a pretty normal reaction given all the headline news that we had,
Yeah.
mostly on the negative side in the market. Just kind of does what it does, which is a reminder that you can't predict these things in the short term. Prices are going to bounce around quite a bit. And what you really need to focus on is the long-term goals that you have. And just a reminder that financial planning is a process, not an endpoint, and
Right.
not really worrying about what's going on short-term, because that's going to drive you crazy. So it's good to know, but not to base your decisions on it.
Absolutely. Absolutely.
So with that, Dave, it's been a pleasure. I
Yeah.
will see
Fun as
you here
always.
next time, and we'll have this conversation again next quarter and see how things go from
See
there.
where we stand. All right. Thank you.
Thank you, sir. Thank you for joining us for another chat about your retirement and finances. Please hit that subscribe button. You can also contact us at srbadvisors.com or email us at info@srbadvisors.com. See you next time on Kitchen Table Finance.
This is a Zedia Media production.